Welcome to The Retirement Lens, the podcast where we break down complex 401k record-keeping concepts and bring clarity to the foundation of your daily work. In today's episode, we're zeroing in on a topic that impacts every participant, account, yet often remains misunderstood: unit accounting. If you're new to record-keeping or brushing up after some time away, this episode is your go-to for mastering this core domain. Segment 1. What is unit accounting? Let's begin with the basics. Unit accounting is the method most commonly used to update participants' accounts within a record-keeping system. Think of units as slices of a fund. Participants don't technically own a fixed dollar amount. Instead, they own units, and those units fluctuate in value just like a stock price does. Every investment fund in a 401k plan, whether it's an index fund, bond fund, or company stock fund, has its own unique unit value. This value is updated on a regular cycle, usually daily, based on the market performance of the underlying investments. Segment 2. How contributions become units. Let's talk about what actually happens when a participant makes a contribution. Say Jenny contributes $100 to her 401k. She directs this to Fund A, and on that day, Fund A has a unit value of $1. That means Jenny purchases 100 units of Fund A. Here's the key. Jenny doesn't just own $100, she owns 100 units. As the market changes, the value of those units can go up or down. Let's walk through Jenny's account over 4 days with no additional contributions. Day 1, 100 units, multiple by $1, $100. Day 2, 100 units, multiple by $0.75, $75. Day 3, 100 units, multiple by 2 dozen, $200. Day 4, 100 units, multiple by $250, $250. Even though she didn't contribute more, her account balance changed because the unit value changed. Segment 3. 5 years later. A grown-up account. Now fast forward 5 years. Jenny's account has grown, diversified across 3 funds: Fund A, Fund B, and Fund C. Here's the breakdown. Fund A, 5,000 units, multiple by one's Kara's $5,000. Fund B, 10,000 units, multiple by 2 Dwalbeats, $20,000. Fund C, 3,000 units, multiple by 5, $15,000. Total account value, $40,000. Each fund's unit value is updated daily, typically at 4 p.m. Eastern when the NYSE closes. This daily valuation allows participants to see real-time impacts from market movement and investment choices. Segment 4. Enter the stock funds, unit versus share. Accounting. Now let's complicate the picture, but just a little. What if the participant is invested in employer stock? That's where we may see share accounting instead of unit accounting. Under share accounting, instead of buying units, a participant buys actual shares. For example, if a stock is priced at $80 and a participant contributes $100, only one share can be purchased. The extra $20 remains as uninvested cash, essentially idle until the next investment opportunity. Most plans use unit accounting to avoid delays in share settlement, but when share accounting is used, systems must also track these cash fragments separately. Segment 5. How stock funds affect transactions. Stock funds don't just change how accounts are valued, they also affect how transactions work. Fund transfers. Plans may allow participants to transfer stock fund balances separately. Fund reallocations. Some plans offer reallocations that exclude stock funds, allowing a participant to rebalance without liquidating company stock. Loans. Some plans let loans exclude stock funds to preserve cost basis or avoid unwanted stock liquidation. Segment 6. Diversification. A legal requirement. Diversification isn't just good advice for ESOP participants over age 55 with 10+ years in the plan. It's a legal right under ERISA. It allows eligible participants to transfer part of their stock fund into non-stock investments. Over 6 years, participants can move up to 50% of their post-1986 stock contributions. 25% over the first 5 years, and another 25% in year 6. Segment 7, dividends, reinvest or cash out. When stock funds pay dividends, participants may have options. Reinvest the dividend back into the stock fund, transfer it to another investment, or receive a cash payout, also known as a dividend pass-through. Dividends paid in cash are taxable and reported on a 1099 DIV, but they aren't subject to the 10% early withdrawal penalty. This feature allows participants to access money without taking a loan or withdrawal. Segment 8, distributions, cash or shares. When participants leave the plan or request a withdrawal, they may take distributions in 2 forms: cash, where the stock is sold and value is paid out, or in kind, where they receive physical shares. If a participant has $1,520 in stock at $50 share, she could receive 30 shares and $20 in cash for the leftover fractional share. Rollovers can be done to an IRA, but only if the IRA accepts shares. Most qualified plans do not. Segment 9, tax time, cost basis and NUA. Taxes on stock fund distributions are complex and hinge on a few key values. Cost basis, what the participant originally paid for the shares. Current value, what the shares are worth at the time of distribution. NUA, net unrealized appreciation, the gain between the cost and current value. Participants are taxed at distribution on the lesser of the cost basis or the current value. The rest, the NUA, isn't taxed until the shares are sold. It's a potential tax deferral strategy and a big decision point during withdrawals. Segment 10, key takeaways. Let's recap what you've learned. Unit accounting measures ownership in funds through units, not dollars. Unit value fluctuates daily with the market, impacting account balances. Stock funds may use share accounting and can involve uninvested cash. Special transactions like diversification, dividend elections, and in-kind distributions are critical for stock fund management. Taxation on distributions depends heavily on cost basis and stock value at distribution versus sale. Understanding these mechanics empowers you to support participants accurately and confidently. Thanks for joining me on today's episode of Retire Right. If this helped you understand automatic enrollment just a little better, consider subscribing or sharing this episode with a friend who might benefit from it too. Remember, this content is for educational purposes only. For the most up-to-date rules and changes, always check the official IRS or Department of Labor websites.